Well, welcome back. Well, the second read on third quarter GDP out next week. Economists are expecting economic growth of 2.9% in the quarter. That would be up from last month's estimate of 2.6%. Joining me right now is the Vice Chairman and Chief Investment Officer of the Pension and Benefits Plan at Bank of America. Keith Banks is here. Keith, it's great to see you. Thanks so much for being here. Bank of America Global Research also calling for 3 quarters of negative 1.5% real GDP growth next year. What are your expectations for the macro story in the third quarter as well as into 2023?
Well, you know, Maria, I think the third quarter, the numbers that you just put out there are pretty consistent with what our B of A Global Research team is looking for. But yeah, at this point, I think the third quarter is really backward looking to a point where I don't think, almost irrespective of the number, I don't think it's going to have a big effect on anything. The focus will quickly shift to how does the fourth quarter print look, and then even more importantly, how does 2023 look? And as you suggest right now, our B of A Global Research team is looking for 3 quarters of negative 1.5% growth, followed by positive growth in the fourth quarter.
Okay, so the year will be largely, you think, recessionary then? What does that look like from your standpoint in terms of job cuts, in terms of, the inflation story and the Fed?
We know it's all part of what we think needs to happen. We were looking for inflationary conditions actually in the latter part of this year, but given the strong consumer, and the consumer still has a lot of wherewithal between the savings they have, which are still above pre-pandemic levels, as well as the strong labor market, that's kind of pushed off the recession somewhat. But in our minds, Maria, for us to move forward, for us to see a sustainable rally, because at this point, we think we've seen a nice move off the bottom, 13-14%, but we're thinking between now and the end of the first quarter of next year, you could see another pullback, and that would create an opportunity for people to get in at somewhat better prices. But you need a bridge to the other side. And what that entails, and we think we're going to start to see some of that, is number one, weaker economic growth, which would show you that the Fed's policies are working, inflation peaking and starting to come down, rates, both the 2-year and the back end, peaking and beginning to come down. You're seeing that in the long end right now. We need to see the full earnings reset. And then last thing is the dollar. The strong dollar has been hurting earnings as well.
Look at yields right now, down 2 basis points. The 10-year sitting at 3.810%. Got the final Fed meeting of the year next month. And are you in the camp that the Fed is going to slow up on these aggressive hikes? The investors are largely expecting a 50 basis point hike as opposed to 75 basis point hike at this upcoming meeting in December. You agree?
We do agree, Maria. We think you'll probably get 50 basis points, as you suggest, followed by 25 basis point hikes the following 2 meetings. But ultimately, we think the Fed funds terminal rate gets to 5.25, which is a big number. We think the Fed's got to get it there to get the slowdown in economic growth it needs to see. We need to see more slack in the labor market. Otherwise, that sticky wage growth is not going to will continue to work against their inflation plans. So all this has got to fall into place. The primary driver being the rate increases. The other thing to keep an eye on, though, Maria, is the money growth. One of the things that people missed on the way up when inflation really surprised the way it did was how fast money growth was. It approached 30% at one point year over year, and even in February of this year, it was about 27%. We've now gone negative. And so one of the potential surprises in 2023, because of that negative money growth that we're seeing, which we think will get even greater, could be faster declines in inflation as 23 plays out. But we'll see if, in fact, that's what happens.
Great analysis. Todd Pyro, jump in.
I just have a kind of a unique question for you, sir, based upon your pension experience. Are you worried that the major topic that everybody's been talking about for the last 2 weeks, this FTX fiasco, is going to be a bigger player to the overall economy because it has weaved its way into pensions? Obviously, we heard of that one in Ontario. Is that a one-off, or are you seriously concerned that crypto, specifically FTX, has weaved its way too much so that when we weave out of it, it's just going to be another parade of horribles, another addition to the parade of horribles that we're seeing in the economy for 2023?
We don't think crypto itself is going to result in a lot of contagion. Obviously, there are companies that were lenders to FTX. But I think what it's more reflective of is as the economy is slowing, as liquidity is being pulled out of the system through the quantitative tightening and other measures by the Fed, you're starting to see the weak links begin to break. So what you could see is more signs of that happening in the forms of more bankruptcies, more stress in some areas of corporate America. We would be more focused on and concerned about that than thinking there'll be dramatic contagion in the crypto space, a la FTX.
Can I answer something on that, Maria, really quickly to Todd's point? Actually, a lot of investors, those very speculators who are losing their shirts on crypto and all of these assets, are hoping that the Federal Reserve will see an FTX or some of these collapses as like systemically important or risky to the overall financial system. So they stop raising rates and stop withdrawing liquidity out of the market. They actually hope that the Fed misjudges an FTX as something much more important and bigger risk because they want the Federal Reserve to keep doling out the money and pouring the juice into the punch bowl, or go back to that, rather.
Yeah, I think that's wishful thinking. I don't think the Fed is going to veer off course. I mean, right now, they are made it very clear. They are singularly focused on inflation and the need to bring inflation down. You're already seeing the impacts of higher inflation, across the consumer spectrum, but especially for the lower income cohort. So I think they'll pay attention to what's going on in the crypto space. We do not think that alone is going to result in the Fed either slowing down the rate increases that we're anticipating or shifting away from the quantitative tightening that's underway currently.
So, Keith, you don't see this as a contagion event, the FTX collapse?
Not in and of itself, Maria, but I think it is reflective of what we're going to start to see, as this liquidity continues to get pulled out of the system. And we got to keep an eye on some of the weaker companies, the weaker credits, because I think it can manifest itself in that way. And this could be the beginning of that process.
All right, we'll leave it there. Keith, it's always a pleasure to talk with you. Thanks so much.
Thank you, Maria.